A Brexit vote could tank global stock markets and crash currencies. But what is the impact for the bond market? Here with more analysis is Anastasia Amoroso, the global market strategist at JPMorgan Asset Management. So, Anastasia, we've got yields on Germany's 10-year Bund near negative territory, Japan's 10 years in negative territory, and our 10-year Treasury here in the U.S. at 1.7%, which is quite low. Seems like a Brexit vote is the last thing the bond market needs right now.
Well, that's exactly what the bond market is pricing in, is that potentially the adverse outcome of the Brexit vote, meaning that they do vote to leave. And why are we seeing this bond market reaction is because one thing that investors are pretty sure of is if the vote is to leave, then central banks have to step in once again. That likely means that Bank of England has to ease monetary policy. It probably means that ECB follows suit, and that means that the Fed has no choice but to further delay the rate increases. So, Scott, that's what's being priced in the bond markets right now. That's why the 10-year is at that very low 1.7% level right now.
Although we've been seeing bond yields across the globe, sink for, weeks now. If you can unpack some of these events for us, is it the uncertainty that's going to cause all this from the Brexit, the collapse of the pound, a flight to safety, a little bit of everything?
It's a little bit of everything, and what I would say right now is that the markets are completely paralyzed because they don't quite know how to process this Brexit vote, how to process this outcome. It's a completely binary outcome. We could very well get a vote to stay, which would cause a relief rally. We could very well get a vote to exit, which would see quite the opposite. And because of that, investors are very unsure about how to position, other than they know two things. First, if I'm going to position at all, I should position for two-way volatility for either outcome. And second is, and arguably related to the first one, is one of the best ways to position for that binary outcome is to do nothing at all. So that's why I think investors have been sidelined in anticipation of this Brexit vote. And you see market reaction that has been somewhat uneven. It's been most acute in the British pound as the pound sold off. It's been most pronounced in rates for reasons that we just talked about. And equity markets started to price in a Brexit, but I don't think that we're fully priced for the worst of outcomes here.
Well, and you look at some of those polls, and the polls are showing it's pretty neck and neck. But if you look at the odds checker, which uses bookies in the UK to track this stuff, they're actually pricing in a 79% chance of a Remain. But that said, like you mentioned, you need to be prepared for both outcomes. And you say there are actually opportunities in fixed income, especially if we see credit spreads widen following a Brexit?
Yes, that's right. One of the interesting things that completely got overlooked over the last couple of weeks as we headed into this Brexit vote is the fact that ECB has actually started its corporate bond purchase program. So if you judge from the results that we've seen from the program so far last week, they're actually on a pretty good side. They're on a pretty good note. So we estimate that if they keep up the pace of corporate bond purchases at the current pace, that we could be looking at a purchase amount of $8 billion per month, which is quite significant. So the reason why I see an opportunity in credit, investment grade credit, high yield credit, is because spreads have widened out. But all of that has been Brexit related activity. That is not taking a look at what the ECB means for the markets and what it means that spreads should actually move tighter, not wider here.
Yeah, now aside from Brexit, we also have Fed Chair Yellen speaking today on Capitol Hill, and you talked about central banks earlier, but when we have the 10-year at 1.7%, at this time last year, few would have expected it to be that low. Can the Fed raise rates this year with that in the backdrop?
I don't think the fact that the 10-year Treasury is 1.7% is going to be a deterrent for them, but it does mean that they have a lot to do on the communication front. But they would argue that their communication is a function of data, so really what we need to see is better data. I will say that very, very benign Fed outcomes have been priced into the markets, and as you know, the Fed doesn't like to see that. So that's why communication as we progress through the year will be critical, and markets can move on communication, much like they did earlier in May. So that's what Janet Yellen will need to focus on if, in fact, she gets that better than expected labor market report in July. But we'll have to see for that.
Yeah, or maybe less communication. The Fed tends to get itself in trouble when they talk too much. Anyway, Anastasia Amoroso from JPMorgan Asset Management, thank you so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.